Welcome to this presentation about the current industry trends and the analysis that we've conducted in the Building Horticulture Business Capability Program. My name's Bryn Edwards. I work at vegetablesWA, and today I'm joined by Paul Omodei from our project partners, Planfarm.
Morning, Bryn, and morning to all the listeners and watchers.
Indeed. So we have carried out a whole lot of analysis with our participants, and we've managed to put together some industry analysis findings, and we want to talk through that today and share that with you. I think first up, we need to acknowledge the funders and all the project partners in this project. So, that's Hort Innovation, the Department of Primary Industries and Regional Development, as well as the Agricultural Produce Commission, that being both vegetables and the Pome Committees, and then the project partners, which is Planfarm, PomeWest and vegetablesWA. So, just as a brief oversight, the project focuses on connecting business owners with farm management consultants to really dive into their business and analyze it and see what are the efficiencies and what are the profitability gains that they can find. And they do that by interacting with farm management consultants at Planfarm, who take them through a very similar process to that they carry out in the broadacre business. Paul, do you want to say anything more about that service and just how the participants get processed during this?
Yeah, thanks, Bryn. It's a process which involves obviously diving deep into the data set or data that's recorded by businesses in their cash book. So whether that be Xero or MyOb or AgriMaster, whichever one they use to record all of their income and outgoings, drawings, all those sorts of things. So it's a cash book analysis and then a balance sheet analysis too on what the assets and liabilities are of the business. And we go through that in a detailed way to pull all of that data into our system, which then analyses businesses against like for like in Pome or like for like in vegetables. And then we pull all of that together in one larger analysis to look at horticulture as a broader rule. So the growers are involved in providing us some production data from each year that we analyse, the financial data that comes with that, and any machinery purchases, farm purchases, off-farm asset purchases, just to build the position of the business over time, and not just for that year. So obviously today we're talking about a snapshot of a couple of years in Pome and 5 years in vegetables. So we're starting to build a really good data set across those industries in particular, across horticulture, which we're very proud of our data set in broadacre, which goes back some 40 odd years. So we do this one-to-one analysis with our clients in broadacre on an annual basis and then review it a couple of times a year. And that's what we're doing now with the horticulture industry, where those that are involved in this project, which is building their capacity from a business sense, to actually be involved and have us sit with them and have an outside set of eyes on their business.
Super. And so what we're going to talk about today is the sort of aggregated data set from all of those analyses, isn't it?
That's right, yeah. So we're individualising reports for growers, so they get their own report. They're the only ones that see that report. And then what we do with the data set from each individual grower is put it into a confidential database, which has no identification measures. So no one knows who they are or where they are, how big they are. All that we really see is the production data and the financial data given a specific number which is relevant to our database. So that's where we aggregate the individual data. So that's why the one-on-one analysis with the grower is important, because we get to make sure that we're analysing what's truly actually been happening from an operational point of view, rather than just looking at a set of tax financials at the end of the financial year. So it's a very specific way of analysing the business, which is the way we think many businesses should, which is looking at what's actually happened in the year of operation, not just looking at a set of tax financials at the end of the year. Those tax financials are important, obviously, from a tax management point of view, But certainly what we do with this analysis is actually analyse what's everything that's gone in and out of the bank account, why it's been there, making sure that things are allocated to the right costs, to analyse how the actual production performance and profitability of the business has happened for that year of effort.
And I know that every participant that's been through it has found it an invaluable service, particularly in the current context with a steep increase with input costs and labour challenges.
Yeah, correct. So the some of the work we've been doing in recent months with growers is actually looking at what the cost increases going forward are meaning to businesses. So particularly around labour, fertiliser, chemical, repairs and maintenance, which is a flow on of those things themselves, fuel. So a lot of things are going up in farming businesses in terms of input costs. What has been the magnitude of that in terms of the effect on the business bottom line? So we've been doing quite a bit of what we call cost analysis with growers, which has been a really interesting exercise to determine for them how much they need to increase the price of their product by to actually cover just those costs. Now that's not always easy to do in horticulture, is increase the price that you receive. But certainly what it does do is give the growers a really good base to say, well, okay, this is my position statement. This is where my business is at. These are the things that are going up. This is how I'm trying to curb those things, but I need more price. I need a higher price for my product. So it actually holds, I think, the growers in a good position to actually negotiate on price.
Super. Well, let's dive into the data then, shall we?
We will. So, righto. We've been through the introduction and information that you've mentioned, Bryn. So as we talked about, we've got horticulture, which is at a broader basis, but also the Pome and vegetables as individuals. So I think just this was probably a key slide. I know there's a lot of words on this, but just want to pick a few things out. And these are the insights or the overall insights that we got from the project. And I think one of the key things is that the balance sheet of many businesses are quite strong. It's actually with a higher number of growers in it than the first year we did the vegetable benchmarking project three years ago. The data set's getting bigger, so we're actually getting a more stronger data set, which is common. The more you actually get in there, the more likely you are to get a stronger data set. So the balance sheet is a key thing. I think that's obviously a combination of land asset values going up, but also that there has been some strong performances from an operational point of view, profitability point of view, which contributes to the balance sheet. A couple of other things, operational expenses between the top and the bottom producers generally don't differ too much across most of the industries. It's really that income number that really drives. We'll dive into that a bit deeper. One important point there is about the scale and crop type and the region. And I think that's a very similar insight into what we found in that first vegetables project was that it doesn't matter where you are, how big you are, what you actually grow. It's those that are focused on what they do and doing it the best they can that will actually be in the top 25%, and that's still hanging true now. So that's great.
That's a really important point, because I remember when we did the benchmark project, many growers wanted us to, in effect, say you need to grow this crop over this size land in this area, and then we'll be a millionaire. And it's just not that simple, is it? No,
it's not. And look, there's certain. Certainly in certain regions, you can grow different products and get market access and those sorts of things. So, this project is spread from Carnarvon in the north all the way through to Manjimup up in the south. So it's a big geographical region. And yes, there are some products that may have our market access basically of when they can grow and produce and put it into the market. So that's fine, but that's a choice of where you live. So that's purely a choice-driven thing. I guess what I'm saying about the vegetable type and the region is that within each of those regions, growing similar vegetables and or varieties, for example, in apples, there's the biggest aren't always the most profitable. They have their own other issues in terms of scale and labour and those sorts of things. So not saying that the bigger growers aren't profitable either, but doesn't necessarily mean that you're in the top just because you grow a certain vegetable or a certain apple, or you're a certain scale, or you grow it in a certain region. So I think that's very important. And I think the other thing about horticulture is that the businesses can show that they produce good returns, which exceed a lot of other investment types, you know, outside of where you might put your capital. So there is certainly pressure coming on these businesses, Bryn. I think what's really important to highlight here is that, you know, the industry bodies that you're involved with and Pome, I think, need to be extremely aware that while balance sheets are strong and the returns can be good, it's in really tough times at the moment. So I think it's something that we should get out to the general public, that it's not easy to be in a farming situation at the moment, even though there's a lot of hype out there about how land values have improved. That just means making money off it is much more difficult because your asset base has increased. So the cost pressures are certainly coming on, but certainly the best in the business, which are indicated in this analysis by operating profit, are able to make really good returns on capital.
Super.
Okay, so we've got a number of findings across horticulture, vegetables and Pome, which we're going to go through now. And obviously any of our listeners or watchers can actually go back and get a copy of this presentation. So I don't mean to flick through it quickly, but one of the things that we want to just pull out here and determine how we actually present the findings is that in the horticulture findings, so across Pome and vegetables, we've actually ranked the growers based on what we call operating efficiency. And that's basically the percentage of costs. So what you spend to make a dollar. And that's a key driver of profitability, is how well you actually turn your expenses into income. So we've ranked all of the growers as a cohort in the industry. So, sorry, in the Pome and vegetables, when we've put them together, we've ranked them on operating efficiency, mainly because when we did the data analysis based on operating profit per hectare, what it showed was there was a distinct delineation between vegetables and Pome. And that probably is an indication for those individual industries about how difficult it is to actually make money. So the individual industries, so when we did the vegetable findings and did the vegetables against vegetables, we did that on operating profit per hectare, and we did the same with Pome, operating profit per hectare, which is still how you actually determine whether you're making enough money per hectare based on the assets that you employ. So just a distinct difference there, I guess, Bryn, to make sure that when we look at the top 25% in those graphs, is that the horticulture findings are about operating efficiency, which has a very, very high accuracy in relationship to profitability. So we're comfortable that we're actually ranking people on the right measure.
Super.
Okay, so horticulture, just briefly, and return on capital, and this is what it's all about really, is how you turn your investment into cash, and remembering that return on capital is cash returns, not value of the asset increase. So obviously very important that the value of the asset, if it increases over time, whether that be land and water and plant, if you're replacing it, if that increases over time, that certainly contributes to the business wealth. But this is talking about cash returns in the business. So horticulture as a rule, this is 1920s year. So we've got a couple of years of presentation data, and then we'll combine them together. And we've done this for horticulture, Pome and vegetables. The return on capital in that 1920 year of the top 25% was quite significant, you know. So you can see across the average, we have a return on capital target of 8%. And we use that number mainly because if you can average 8% return on capital each year, then over 10 years, you double the wealth in your business. So that's that little dotted line there. And obviously the best performers in horticulture across the board. So this is a combination of Pome and vegetables. We're sitting at that about 18% return on capital. So a significant return in that, 1920 year. And obviously the average in the bottom part of the industry dropping below that target KPI we have of 8%. So remembering that's just the 1 year data. In 1920, the equity, so the equity balance sheets were actually quite strong in horticulture. So we can see that the average of the industry just sits above our target line of 80%. So that's a good thing for the industry. It means that balance sheets are strong. It means that if they need to invest, they can, or if they can buffer against poor seasons, they can, which is a great thing. One really key component here is that we're starting to see the top 25% do have much stronger balance sheets. That's into the 90s now, whereas the average of the industry is just below 80. So the good businesses are very strong businesses as well. And operating efficiency, this is again the single year results. So this is the percentage of costs as a percentage of income. So what that says, at 78%, the average of the industry spent 78 cents to make $1. Now this is the engine room. So the lower that efficiency is, the better the business is at making money. And obviously that little grey line, or that grey part of the bar there, is contributing to overheads such as drawings in the business, interest, tax, depreciation. So that 78% number is really critical. We believe in the horticultural industry that target should be less than 70. So you can see the average of the industry is above that target, which means they've got less money left over after operating costs to actually pay for those overheads. So if you've got a high overhead business, you need that operating efficiency to be as low as you possibly can so you can contribute to those overheads. So that was that year, and then the return on capital in 2021. So similar graphs, you can see the differences in years now. Bryn, I suppose, is what we're seeing. So a really tough year in 2021 for horticulture as a rule, and mainly driven by yields and pricing was a big thing, but also we started to see those increasing costs as well. So the return on capital certainly dropped, but again, a distinct difference between the average and the top 25%. Albeit the average of the industry was still maintaining just under 5% return on capital, and the top 25% were just hitting on 7%. So, I think the returns are still there, but you can see that it's getting tougher for producers. And again, the equity percentages, 1 year on, a few more data sets actually, Bryn, from 1 year to the other across horticulture. So again, just the strengthening of balance sheets again here. So just seeing the real importance of a higher number of contributors to the data set, and more growers in, the better the data becomes, the stronger it is. So a good position from an equity point of view, but like I said earlier, as your increase in assets increase, so if the value of your land increases, you have to make more money to actually make that return better. But the equity does mean that they're in a good position to handle a poor year, which horticulture has been through a number of in the last 5 years. Okay, and this is probably again depicting the year that it was. So their operating efficiency, it's at 80%, slightly higher than the year before. Yeah, so just, it's a very important factor, and it just means that the costs that were employed to drive income were going up that year. So the income didn't respond, or the costs were higher. So a combination of both. So, a really important metric that we use a lot of. And we then use this data for each of our growers to dive in and say, okay, what is affecting this operating efficiency in your business? So that's where the conversation starts.
Yeah.
And horticulture. So we've got 2 years of data across the industry now, obviously. So we've got 2 years of Pome and 2 years of vegetables, being that last 19, 20, 21 year. And I think the key part of this industry results is just that we've got 2 years of quite good returns for the top 25% and then lower ones. But what we're starting to see is this operating efficiency come out as the key component of where I think businesses need to really keep concentrating on, whether you're in vegetables, Pome, and even other industries that aren't involved in this project at this stage. So, the 2 year average close to 80%, it's at 79%, 9% higher than we'd like you to be. Like there's 9% of income, which is going to costs that aren't being rewarded back. So the return on capital at 5.5%, arguably still a good return, better than cash returns. Arguably, is your capital better to be in the share market? Probably not in recent times, but these are the things that growers can make decisions on. And obviously equity we mentioned was, the businesses are in a strong position. So yeah, look, and a couple of graphs at the bottom to just depict the difference between 19, 20, and you can see that variation. And I think when we get to vegetables, we'll really hone in on what the 5 year data set looks like, because you start to really pull out some interesting information on equity, return on capital, and operating efficiency, which are key drivers.
Yeah.
Okay, so vegetables, so similar, and this is pulling out. So that was horticulture as a whole, vegetables and profitability. Look, some really key things now starting to still flow on for that earlier project, Bryn, that was initiated by Vegetables WA, is now flowing into this building business capacity project, and that is saleable yield. And this sounds like a oh yeah, that's common sense, but this is really now the key thing that is driving the difference between those that are actually in the top 25% and making really good returns off their assets. And market access is obviously becoming the other one. So no, that doesn't necessarily mean that you have to be big to have market access. It's about relationships with customers and buyers. Obviously scale certainly helps if you've got more to sell, but that aside, I think if you've got good production systems, you have good yields, and you sell a good product, then you actually have a good place to negotiate. And we're certainly seeing that come through. The third point then, focusing on a limited range of products. I think that is becoming a key component of any business, and it's a simplified business. It means that the growers, the growing system, the employees, the management staff, everyone's on the same page as to what needs to be done. It's very regular. So that's becoming something that's we're pulling out as those that are an attribute of the key top 25%. So they're keeping things very simple. They do it well, and they do it well often. And then, land utilisation is the other one, Bryn, which is really, the ability to actually grow either multiple crops on the same area of land, and utilise that land better throughout the season. So obviously that will be determined by where you are and where you grow and what you can grow at different times a year. But certainly the optimising land use is one of the notable attributes that we can see, that growers are planting multiple crops. So they're using that land. Okay, their costs per hectare are certainly higher, but their revenues are certainly much higher as well. Yeah. Okay, so 1920, let's skip through again. So that, 1920 and 2021 results. So a really big, this graph is not scaled particularly any way, except that we had to capitalise or capture the income of the top 25%, which you can see there is a massive, very close to $160,000 per hectare. So again, crop type, multiple crops, time of season that you're growing in terms of getting a better price. So I think there's a couple of things that are sitting in that top 25% group, but you can see that grey line, or that grey, dark grey, black line, bar graph is showing the costs per hectare. So the green is the income, the grey is the cost per hectare, and then the blue is the operating profit per hectare. And you can see the difference between the average of the industry and the top 25 is that the actual cost per hectare are not much different at all. It's about,
they're pretty identical, aren't they?
Yeah, it's $4,000 or $5,000 a hectare. So it's not a very big number at all in terms of the cost per hectare when you think about the revenue that per hectare that can be gained. But you can just see that massive difference in revenues, the average of the industry and the top. So, and that is obviously having a big contributor to that light blue bar, which is the operating profit. And obviously the bottom of the industry, really needing to make some decisions as to what they're doing and whether they still want to be in the industry. So 1920, a couple of ratios or some key areas to look at that we like to look at. And one is labour, and obviously very topical at the moment. And one of the things we were looking at and look at quite regularly in horticulture is wages as a percentage of income. But I think you can see by that graph on the left-hand side that the wages as a percentage of income is now skewed because of such large incomes of the top 25%. Yeah. So the green bars here being the top 25 and the average being the black. And you can see that the 12% of income as wages as a percentage of income is 12%, and the top 25 is because their income was so high. So yes. I think what's probably just as relevant to look at is the wages as a percentage of operating costs. So as a chunk of your costs, wages we know is the biggest one of those for horticulture. So what does that difference look like for the top 25 versus the industry? And you can see there that in this 1920 year. It was 25% for the top 25 versus 34 for the average of the industry. So a significant difference, albeit the actual cost of labour per hectare was similar.
Yes.
Okay, so...
And this has nothing to do with mechanisation either, does it?
No, it doesn't. No, there's nothing here that's related to mechanisation being in the top 25%. So are some in there? Yep. But some that have mechanisation are not. So I think that's a good point. The operating efficiency, obviously that target number of 70% that we've talked about before. So you can see the top 25% were well down on the operating efficiency. So the target was well met by the top 25%, but obviously the average of the industry there pushing close to 80. So, I think this is one of the things where businesses, as part of this project, are really starting to dive into what that means for them. Where is it? Is it in the costs? Is it in the income, or is it a combination of both? And what can we have an effect on? And obviously to the right there, we've got our vegetable income per hectare. I mentioned that before, the massive difference. And then the return on capital, the average of the industry just doing over 6%, and the top 25 doing just under 20. A big difference between the best and the average. 2021, so similar type results. I guess what we're showing is not a lot of difference between. You can see the pattern there. Bryn is higher income for slightly higher costs. So we did see in 2021. If I just skip back to this one, so the top 25% in 1920 was spending just under $80,000 in hectare. In 2021, that number pushed closer to just under $100,000 a hectare. So again, more growers in the data set of a different type, which is giving us some more strength around the data. So, but still a large difference in income between the average and the top 25.
You can still see that big difference of what they're actually getting on in terms of their returns.
Right. Yeah, that's right. And similar results to the 1920 year, with the wages as a percent of operating costs. So you can see then in the top 25% are 28% of their income, of their operating costs, and the average of the industry sitting at 33, which was very similar. The average of the industry at 34 the year before. So we're starting to get some really good numbers now around what the actual costs should be of labour as a percentage of operating costs. And then your operating efficiency, again, you can see the lower number for top 25, which is what we're after, and the average of the industry still sitting up around that 80%, which is just way too high. Vegetable incomes and then return on capital, a much tougher year for the vegetable guys in that year, which is affecting the overall results.
There's almost a difference of like 20 cents between the top 25 and the average there, isn't there? In terms of how much they're spending to make that dollar.
That's right. Yeah. So the I think they were just the 61%, I think it was, for the top 25 versus nearly the 80. So 18 cents in every dollar more is being spent by the average of the industry. To make that dollar. So that, to me, that would be a real place to go and look at your business. Okay. We're very lucky to have that previous project, Bryn. So we've been able to pull together 5 years of data. So this is the 5 years of data from vegetables, which includes right back to 17-18 year and all the way through this last couple of years that we've analysed. So we're really starting to get some strong data now in vegetables across a range of vegetables. The average operating efficiency, it seems to remain at a constant level now between 74 and 77%, and the return on capital for the industry somewhere between that 6 and 8%. So we're starting to get some really good numbers, and they're not always just the same growers. The grower numbers are increasing each year, so we're actually getting different growers in. So that's not just the data set of the same old growers from 5 years ago. So I think what's really interesting there is if I look at this 74 to 77% operating efficiency, that's the area where growers need to concentrate. And this is the data, a really strong data set now, which gives you that individual year ups and downs and how they move. So it's good to see this from 16-17 through to 2021. And you can see the variations there. If we look at operating profit per hectare, we've gone from 16-17 of nearly $13,000. And then obviously as the data set's got much stronger, we're starting to get a more relevant or relative, I reckon, to what's happening in the industry, which is that up around that $25,000-$30,000 a hectare of operating profit. The operating efficiency sits at that 75 and still above that target that we believe the industry should target for, which is 70%. So, but a return on capital, you know, you wouldn't sneeze at that, Bryn. I mean, as a 5-year average, you're not too far away from the 8% that we like to target in Planfarm to have a business double its wealth over 10 years with that sort of return. And importantly is the equity change. And this is just, again, the strength of the businesses that are involved in the project, which has been really enlightening for us, is that better and stronger businesses are interested in looking at what's happening in their business, and so they're coming into the project, and we're starting to see that flow through. And bearing in mind, there is a bit of land value increase happening there. So land values have increased significantly the last couple of years, and that will be picking up on some of that as well. But that's still real. It's a real number in the balance sheet. And I'd just like to look at draw people's attention to this graph down in the bottom left-hand corner. This is the operating profit result and the operating efficiency, and you can see the variations from year to year. So the bar graphs are the dollars per hectare, and then the line is the operating efficiency. And obviously what we want to see here, Bryn, is that over time, these businesses in the industry are actually driving a bar graph that's going upwards to the right. Yeah. And the operating efficiency is coming downwards, because that's when you're actually producing, you know, it's almost a crossover. You're producing more operating profit to then pay for overheads and expand or invest in off farm. So, you know, quite pleasing there, pretty good result.
I think it's worth noting 1920 was an interesting year. We had a lot of fire and floods over at the east. But also it caught that tail end of the WA stay-at-home COVID period when restaurants were shut and people were at home, and I think probably, you know, scared for their lives, everybody started to eat their 5 portions of veg and fruit a day.
So again, I mean, that would be, you know, is it a demand thing? Is it a price thing, or is it just the saleable yield thing? You know, so those that are producing
some more investigation.
Yeah, certainly. But certainly one thing that a longer term analysis and being part of a project like this does is that it actually picks up those years, but also picks up these years in 16-17, which was TPP, you know, and you start to get a feeling of what's actually happening in the industry. But more so, I think the important thing here is that this operating efficiency is just such a big area for growers to focus on. You know, what are they doing? What can they do to improve that? Is it mechanisation? You know, there's a lot of these things being thought of at the moment. And I think if you think about mechanisation and labour costs on its own for a minute, then you've got businesses that are showing increase in equity. So their balance sheet is strong. So their capacity, their borrowing capacity, or their capacity to fund business expansion, and that might be in mechanisation, is quite strong. You know, if the businesses were poor equity or down around the 70%, then their ability, their capitalisation, you know, the capital in the business to use to then invest into productivity gains would be limited. But we're finding that there actually is good equity in businesses. They're well capitalised, and that is an area they need to look at to actually see if they can bring down operating efficiency, because that will drive their profit.
It's a big focus, I guess, for each individual business, but I guess for, you know, like vegetablesWA and other industry bodies to consider, you know, the future prosperity of an industry as what can we systematically do to start bringing that line down as well.
Yeah, if anything at all, but where's the support needed? Because I think it's one thing to say, you know, businesses are wealthy because they have 84% equity, but they still have to make a return on that. They still have to make a living on that. And if if that is the case, then these are the areas we need to be looking at. Hence why we did that cost analysis.
Yes.
For many growers was, okay, if these costs have gone up, how much do you have to recoup in extra price? You know, how much do you have to go to your supplier and say, well, look, my costs have gone up by 5 cents per kilo, 10 cents per kilo, whatever the number is. I need that just to stop going backwards. So that's, you know, I think the data is very strong.
Yeah.
All right, so that's vegetables. So the Pome. So the first time we've had some Pome data sets in the last couple of years, which has been really enlightening for us. And the growers have been fantastic to work with, which has been great. We certainly want more of them. But again, the Pome profitability differences, or the things that really stand out to us, and saleable yield is absolutely a big one. Now, I think in Pome, what's really interesting is that there's a few more controllable factors around saleable yield. Certainly there's seasonal effects that can be real killers to businesses, but no different to what we see in Broadacre with frost and those sort of climatic events that you can't control. So, but some of the things in saleable yield and controlling that from a Pome point of view is, I think we've picked up at tree maintenance, like pruning, but also now these closer spacings, the high density spacings, nutrition, tree and crop protection. So obviously netting is something that the industry itself is investing heavily in and has been for a number of years, certain growers. So that's a good thing to see. And then obviously some of the harvest practices and timing, I think, you know, what we see with the top 25% is they just don't miss on timing. And that's a really important thing when you've got a product that actually goes off pretty quick if it doesn't get picked on time. So in terms of varieties, I think, you know, there's not something that points to a specific variety, and neither should it, because obviously consumers are wanting a broader range of varieties. But yeah, there's no specific variety itself that's actually standing out to us. The investment into capital, and I mentioned about netting, high density spacings. So I think these things here are really typical of those that are in the top 25%. And they've done those investments earlier or sooner rather than later, and probably making the change to take out some older varieties and put in newer ones quicker. So that's been interesting. And obviously the systemisation of labour. You know, there's some really sophisticated labour tracking systems out there with growers in Pome, which is really, really interesting to us in the industry, through things like pruning, thinning, picking. So particularly picking, just tracking different labour or different employees as to how they're actually going with their efficiency. So a lot of challenges for the industry, but certainly some exciting stuff that's happening there. And the other little one, I guess, at the bottom is just the pollination varieties that are in and out of orchards now. So, you know, proper spacings of those. I'm not a guru on apple agronomy by far. You know, there's some lot more brilliant minds out there than me on that, but certainly one of the things that we've picked up is it seems to be that that production, so yield of those varieties that you're chasing, and pollinators within the orchard are quite important. So that's been interesting for us. Okay, so how does it look in Pome 1920? So 1920. Again, similar graph to what we've seen in the vegetables. So the green being the operating profit, the income, the black being the operating costs, and the light blue being the operating profit per hectare. So what we saw in 1920 was our first year dipping into the Pome growers. I'm going to skip through this a little bit, Bryn, because once we get to 2021, we start to see some similarities between the 2 years. So obviously the income number again driving the difference, you know, between the top 25% and the average of the industry. And a slight difference
in those operating costs, even where in vegetables we saw the top 25 and the average very close, and then the bottom 25 is almost a bit lower. Even the bottom 25% here is comparable to the average and the top 25.
Well, it's definitely comparable to the average. I think what we've probably seen is this little gap starting, like it's nearly $20,000 a hectare. You know, I think it's $18,000 a hectare from memory. The difference between that cost of the top, cost of the top 25% at 80, and the cost of the average of the industry just above 60. So that, I think that's starting to be a gap that's starting to move. So is that, you know, what is there in there? What are the top 25 spending more money on? You know, is it wages? Is it fertilizer? Is it, it won't be netting because that's a capital cost. So these are operational costs, remember? So what is happening there to actually get that yield? So that's an interesting dive into that. And then obviously here we're starting to see this gap pull apart from the average to the top 25, and that's around apple yield. You know, so here we're seeing I think it's just under 11 tonnes to the hectare difference between the top 25% and the average of saleable yield. You know, this is not just yield and then dropped on the ground or not being able to be sold. This is saleable yield. And then the similar ratios that we've talked about before, operating efficiency, you can see the top 25% again are under there. They're just slightly coming in at under 60%, which is a really, really good result. And one thing we have noticed in the home growers is that they are much closer to the 70% target operating efficiency than vegetable growers are. And so that just tells us that what they're spending, they're actually recouping in income to maintain that ratio. Certainly the top 25% don't have the highs of the income per hectare, but still just over $120,000 per hectare of income, good number to have at an operating versus the industry average of just under 100,000, 97,000, I think it was. And again, on the far right is the return on capital. So the best in the industry doing 10% and the average just doing over 5. I think it was just under 6% for that year. So let's head to 2021. And this is where you're actually seeing this equalisation or closer to the similar spend per hectare, Bryn, which I think you were alluding to before. So, you know, in that year, 2021, which you can see was from an income point of view, the top 25% were slightly under 110,000, a little bit better result from the average of the industry, but the cost per hectare virtually between the bottom 25% and the top were virtually negligible. So the growers are spending similar on operating costs per hectare, but the best growers are getting more saleable yield and income. Now, the question will be out there maybe is, are these growers in the top 25 getting better price for their product? Now in 2021, the difference between the bottom, the average and the top 25% was 1 cent per kilo in price. So that
answers that question.
So it's not a price thing. It's actually all about saleable yield and what you spend to actually get that saleable yield. So a really interesting result and data set across the pome industry across those years. So that was 2021. And I think if you put the 2 years together, the difference in price received per kilo for all growers in the data set was 5 cents a kilo. So not very much at all. All right. So in that year, again, we can see the apple yield driving. So just under 10 tonnes per hectare. So that's really and this is the average yield across all varieties, and this is saleable yield. Operating efficiency, again, the best are under the 70% target, and our pome income per hectare, you know, the gap is closer between the average of the industry and the best, and 2021 wasn't the best yield and price year, but the return on capital shows that, I think, is at 6% for the best, and the average of the industry sitting at just under 4. So a tougher year again in 2021 for apple growers. And their 2-year results, again, a smaller data set, Bryn, but I think a really interesting data set in terms of the operating efficiency. And I mentioned that to you before, is that you can see that the average of the industry sits at that 72% over the couple of years. So certainly whatever they spend in dollars of operating, they're able to actually get that return in income. So we're seeing that difference between them and vegetables, but the returns on capital certainly far less for the Pome growers over those 2 years anyway, for the data we've got. That's not necessarily meaning historically or going forward, but certainly for those 2 years sits at just under 5%. And then again, an equity percentage whereby the growers are actually well capitalised in the industry. And again, here, I think for the industry, this is well capitalised in their businesses to look at investment into closer spacings, high density spacings, netting, replacing older varieties. So if the business's ultimate visions and goals are to continue into Pome, then obviously making some of the decisions around that or doing that return on investment analysis is quite a simple thing to do, to look at whether it's valuable.
Yeah.
And the operating profit result, so over the 2 years, and the operating efficiency. So what we're trying to depict here is a similar graph to what we've done with the vegetables. Bryn was actually gathering this data together over a number of years to actually see where the industry sits. So what we'd probably see here more likely is the difference between 1920 and 2021 being up and down years, but certainly it can still show that the return on investment can still be there, the return on capital can still be there. It's below some of the targets in 1 year. The operating profit can improve, but the equity, so the capitalisation of the businesses is strong, which is a good sign.
Yeah.
Okay, so that's the analysis, Bryn.
Yeah, it is. Yeah, so I think there's some really interesting trends to take out there for individual growers, for industry bodies, and for stakeholders in general. I think it's going to be really interesting as we go into the next year, and we'll be going again, analysing businesses and taking them through the same process. We plan to have that completed in the next 6 months. So hopefully coming back with the next set of benchmarks around about January time in 2023 for the financial year that's just passed. Are there any sort of closing remarks you want to make there, Paul, before we?
Yeah. No, look, it's been really, we've been very privileged actually, Bryn, to get deep dive into those two industries. It's certainly like more industries involved, and obviously very appreciative for the funding bodies and the industries themselves, Pome and vegetablesWA, the APC, so Hort Innovation, all of them deep-heard. So it's just been a massive contribution. It's been really good for our business to be involved. I think the one key thing about this year going forward is that we're sitting here in July, so the 2021-22 year has just finished, the year of effort for Pome and vegetables. We'll be collecting that data from current growers in the project virtually now as we speak, analysing while it's fresh, which is very important for us. So it's fresh in the growers' minds. They know what's happened, and then we'll culminate that in some more benchmark data, which will be stronger again because we'll have 6 years of vegetables and 3 years of Pome.
Superb. So if you want to dive further into this presentation, it's freely available, and you can see from this slide we carried on and did a bit more analysis of the management practices, so you can start to see what some of the top 25 were doing in their businesses that may have delineated them, and also some areas in the industry that need a bit more focus, as well as provide a few success stories of actual impact that we've had with growers. So thank you very much for your time there, Paul. Thank you, Bryn, and I hope the listeners and watchers get something out of it, and feel free to contact either yourself or myself if we've got new growers interested. Thank you very much.